Hello, I'm Mark Faris. I'm the CEO of Faris Capital Partners, and John and I, we run a real estate investment firm that has 100 million in multifamily assets. And so this podcast is all about why multifamily investing is one of the best opportunities in today's market. And today is going to be talking about an alternative investment, and that's the stock market. There's a lot happening in the markets right now, and it's a little bit of a roller coaster ride. So we're going to be talking about some of the pros and cons and the differences between the stock market and investing in real estate and the opportunities that are in front of us today. John, it's great to be here with you.
Mark, it's interesting. It's great to be here, but we wrote this outline and here we are a couple of days later and the information was completely outdated, right? So I think you nailed it. It's a roller coaster, a wild ride, whatever you want to say here. And we're recording this on April 20th at 8:13 a.m. So the stock market hasn't opened yet, but the previous Friday, all of a sudden the straits open for business, everything's great, stock market goes up, oil futures go down. And then on Saturday, the straight closes again. So, now as soon as that stock bell rings at 9 a.m., we're going to see oil futures up and stocks back down, right? And so I think for me, what it really boils down to is we could sit here and go through some of these stats and statistics, but likely by the time somebody listens to this, they're going to be outdated. But, bottom line is we've seen a lot of just disruption, whether it's the tariffs from a number of years ago, last year, Liberation Day, as Trump called it, this war with Iran. And so we've seen, the S&P 500 down as much as 7% and then stabilizing. A year ago, we saw a 12% drop in the stock market due to the tariffs. And so it's just very difficult for an investor to make intelligent decisions on what to invest in the stock market when there's so much uncertainty in the world. And, candidly, there's a lot of things happening behind the scenes. I mean, there's been some allegations of insider trading happening. And so, for me, I'm not ever encouraging somebody not to invest in stocks and bonds. It's all about diversification, and every smart investor knows that. But in these types of times, as an investor, you need to look for investments that have more predictability and stability, and that also are somewhat inflation resistance, which is why we really like multifamily, right? And we're going to dive into why we love multifamily in particular. I think hard assets are really what, are the thing investors are flocking towards, but we specifically like multifamily, and we're really going to dig in that today. So, we've also got midterms coming up, Mark, and that's going to create a whole other level of uncertainty in the stock market. So, it's just that idea. Like for me, I don't know about you, Mark, but I've just sort of done a set it and forget it with my stocks and bonds right now. My financial planner watches it and occasionally calls me with a trade, but we're not trying to panic sell or buy at the peak or buy at the bottom. We're just sort of riding the wave, so to speak. But my new investor dollars are all going to real estate these days until we get some more stability in the stock market. So, let's talk a little bit about that pricing gap, why it's still wide and, what's still happening in the marketplace.
Yeah, for sure, John. And this is where I was on a call with a group of investors the other day, and they asked me, "It's like, well, how is this going to impact that? Well, with the war going on and the uncertainty, how's this going to impact real estate?" And I was like, It's like, well, there's two main dates that are really important when it comes down to real estate. It's the time you buy, the day you buy, and you lock in a price, and the time that you sell. And so that's like really good. So this is where when we're talking about the stock market and real estate, I think that both can do well. The thing here is the volatility is like I think some of the main messaging, and then in a market like today when you have such an incline over the last 5 years in the overall equities market, and then the last few years we've seen such a decline in the real estate market. We know that both go in cycles, and it's kind of like a yo-yo going up an escalator. The challenge is that with the equities market and stock market, there's bigger ups and downs, and this is where it's really challenging with that. So the answer that I gave the investor was, you know what, because we locked in at such a great price, like we want to be buying in the time of uncertainty right now. And this isn't changing our business plan. Our business plan is to go in over a period of 3 years, and I'm speaking to about all of our assets, but in particular our recent acquisition in Atlanta, which is again phenomenal
Yeah.
purchase that we got. But you want to be buying in a time of uncertainty. You want to be buying in a time when there's war going on. You want to be buying in a time where there's uncertainty with interest rates. And so the answer is I don't see this impacting it at all.
Yeah.
because we got it at a great price and we're not going to be selling over the next few months. There's 3-year business plan, and this is where the approach is very simple. We go in, we add a lot of value, we increase the assets worth, and in the meantime, we rake in all the cash flow that's coming through the asset of real estate, through the income that's coming in above and beyond all of our mortgage payments and whatnot that we're doing on our multifamily properties. And when we go to sell in 3 years' time, the market is, and the data that we're seeing right now is telling us that we're going to be in a much better spot right now
Yeah.
in 3 years. But even if it stays the same or even if it declines slightly, we're still going to be well ahead because we're not waiting on the market. It's not a waiting game. It's let's add value and force the appreciation in. And then as the market does its trick over the 3 to 5% appreciation that happens, that's where you get, we'll say, some further fireworks. And this is where, John, for me, one of the biggest things with real estate is that you can actually have an impact. You can actually control what happens with really strong operation. And I would say that is one of the biggest opportunities when it comes to, like, especially multifamily real estate compared to the equities market.
That's right. So, just some headlines that are worth talking about because these are steady, stable statistics, that aren't going to change, in 2 days, right? So, real estate has repriced approximately 20 to 25% from its peak in 2022. And so, really, 2024, based on the data we're seeing today, seems to have been the absolute bottom, and pricing is starting to adjust. Now, you mentioned on Smyrna, we got that deal at about $153,000 a door, where similar comps that traded in the past year were selling 160 to 180 a door. And we're talking about similar vintage, in some cases, actually older vintage, 70s vintage, which, as a lot of our listeners will know, 70s vintage aren't necessarily, you should avoid them like the plague, but, there has to be a very strong case. In fact, in all of our, history, we've only acquired one 70s asset building, and that was because we got it at $95,000 a door, right? So the pricing was so compelling, it made sense. We're seeing the valuations of equities in real estate, sort of, in this interesting moment where equities are actually at a 3-year high, even with some of the volatility. We've seen a 3-year positive run. And so what's actually happened is the pricings to earning ratio is way out of whack. And so, in other words, stocks are valued much higher than their actual worth should be based on revenue, right? And profit. And so it's only been higher 25 times in market history. And so it's not to say we have a crystal ball and we're predicting a recession, but we are in a cycle of where we've been going up, up, up. And so realistically, something likely will happen soon here, especially given we're seeing higher inflation with oil costs. So, Morgan Stanley recently put out a report and they said, look, real estate assets having been repriced 20 to 25% below their peak value is creating a widening gap between rising replacement costs and current market pricing. So, that's another thing we really hadn't touched on yet on this episode. We've mentioned in the past, but because the cost of materials, the cost of labor, land costs, and regulatory costs continue to rise, to build a new building is just getting more and more expensive. So when you can buy a value add asset like that deal we're acquiring in Smyrna, Georgia, below replacement cost, dramatically below replacement cost, as development starts to tick back up in the coming years, it'll pull the value of our building up. So, look, I think the main thing, and this is my main point, is real estate is not subjected to a presidential tweet, right? Like, in other words, you can't really kind of send a message out into the market that is going to destroy the value of our building, right? Where, a presidential tweet saying, hey, the Strait of Hormuz is open and the stock market goes up 800 points, right? And then the next day it's closed again. So it's not to say, we're not trying to get political here. We are just in a very uncertain time. And so for me, I look for stability in these types of environments, and real estate, particularly multifamily, affords that. And one of the main reasons, and it's, something that I think is always worth hammering on, is that when you're dealing with multifamily residential apartment buildings, we're able to reset our rent on an annual basis. So it's why we prefer that asset class, say, as compared to office or retail, where sometimes, tenants are locked in for 5 to 10 years with a rate that's agreed to, right? There may be some escalations in there as the lease kind of moves down the line. But in real estate, we're able to reprice on an annual basis. So as inflation goes up, we're able to capture that in rent. And so it becomes very inflation resistant, right? And it's one of the main reasons we love multifamily.
Yeah, 100%. John, it's never nice when you wake up and you're like, oh my goodness, my net worth just dropped by 10%.
Yeah.
Like that hurts. It's like, especially when you have you have millions of dollars there. It's like, oh, this was not a good day, honey. Right.
Yeah.
And it's
That's right.
interesting because even though you don't sell the asset, you still feel it. And
Yeah.
so it's this emotional roller coaster, and you got to have some really strong fortitude to be able to, hold through that. Now, the thing right now that we really want to get across is that if you have an asset class that is at one of its, all time peaks, and then you have another asset class that's dropped significantly and is at a low from where the top of the market was, that's when you really want to be careful of new investment dollars going in. And so it's interesting because as a real estate broker, selling over 14,000 properties through the 20 years of selling these properties, I realized that when the market was really hot, everybody loved buying real estate. They were excited to buy more of it, even though the pricing just jacked up by 20-25%. They're like, man, this is great. And they're buying at the top of the market and it feels good. And, when the market drops 20-25% and you buy, nobody is patting you on the back saying, oh, great, you bought another investment property.
Yeah.
It's just not. And so this is where one of the big messages that I'm getting across to all of our partners is encouragement to take action when there is a lull right now, and to really be cautious as well. Like when it comes to the equities market, that any new capital going into that, the market needs to continue to do well over the next 1, 2, 3, 4 years. And so this is where there's a real opportunity right now for those that have courage to be able to get into real estate when it's not sexy, when it's not talked about, in a positive light in the news. And, it's, not a lot of people are doing it now, which is exactly the time that you really need to be getting in. And so this is, in our recent asset, John, that we close on, I'm just, especially when it comes down to location
Right.
with an asset. If you're buying at a low and you're buying an asset in a phenomenal location as well, you're positioned really well to not only take advantage of the real estate multifamily investment value add play that we go in and force value up, but the overall appreciation in the market coming out of this bottom is what we're seeing from our
That's right.
analysis.
That's exactly it. So it really just comes down to looking at your current investment strategy. And if equities, stocks and bonds are over 60 to 70% of your portfolio, you're probably carrying a little bit more risk in this environment than you likely intended. So, it's not to go sell all your stocks, right? But just look at what your balance does look like and what that diversification does look like. And even like a 10 to 15% shift from equities into multifamily will meaningfully change your volatility risk and exposure. And so, it's really, once again, it's just all about diversification. And so, that's top of mind for me. I think too, you want to act before the market catches up, because right now we are seeing a major decrease in new supply. In fact, it's 53% less coming online today than at the peak in 2023. And so even with rising costs that I mentioned earlier, eventually the market's going to recognize that opportunity and it's going to become obvious. And so you will start to see new development. Now, one of the reasons we love Class B value add real estate is that in essence, what we're doing is we're improving a B class asset in an A class area so that it feels and has a lot of the same features and benefits of that new A class building, but we're able to offer it at a significantly reduced rent. So for that resident who's looking for something that's nice and comfortable and safe for their family, they get that, but they're not paying, $2,400 in rent or $2,600 in rent that new Class A building needs to achieve in order to reach profitability. We can offer a similar unit. For example, in Smyrna, our one bedrooms, we're targeting 1,400, where there's new Class A a little bit closer into the Brave Stadium that, yeah, it's a high rise and it's, it's very cool. It's got all these great amenities, but it's $2,400 in rent. And so with the pressures we're seeing on inflation and rising costs, people are looking for ways to save money. And so they're going to start downgrading, or downgrading is actually the wrong word, I would say. They're going to start moving a little bit towards these Class B, where they can still get a really nice, comfortable unit, but at a significantly reduced cost. So that's what we're doing right now. We're aggressively looking to acquire Class B value add in the hugely domestic in-migration Sunbelt markets where we're seeing rising population, job opportunities. One thing to definitely note is typically lower cost of living than, say, the coastal cities on the West Coast or the Northeast. And institutional capital is paying attention. Apollo, American Landmark, Standard Real Estate, these big funds are flowing into, they're getting
Mm,
out of industrial and moving into multifamily. So,
mm.
you know, that's what we do, Mark. We just watch to see what are the big players doing, and then we go in that direction, right?
100%. And this
Yeah,
is where, like, at the end of the day, you buy a company, right? That,
that's right.
say it's like Apple or Amazon. Like those are all really great tools. But this is where, for John and myself, it's like we want to be able to invest in an area that we are like, we're confident that that's never going out of business, as in like
Right.
housing. People always need a place to live. And so what we've identified from the numbers and from the analysis is that the middle class, the affordable housing segment is growing, and there's more demand for it today than ever. And in 1, 2, 3, 4, 5 years, that's going to continue to grow because overall cost of living is going up. And I mean, you just go to the grocery store. You know this is accurate. You don't
Yeah.
need a stat to be able to tell you, like, just what are eggs today compared to 10 years ago. You just go buy a steak. Like it's
Oh my gosh.
unbelievable.
Gotta take a mortgage out to buy steaks for my family.
Right? Right? And so this is where, at the end of the day, this is why income producing real estate is a hedge against that. And this is where, John, we've talked about this before. I'm going to say it again, is that I think that real estate ownership is going to be one of the largest, we'll say, differentiators between the wealthy and the unwealthy, the rich and the ones that are getting more and more, we'll say, squeeze on a day-to-day basis. And so this is where we're really encouraging, our partners right now, is like investing in real estate, income producing real estate, where there's very low downside because it's already producing and cash flow on from day one. And we're going in and we're adding value, and a necessity, right? People need a place to live. And so this is like 4 million households short by 2029. That's what the US is projected to be short of homes. And so we're producing and we're providing quality homes for working class people. And you could see, working class, like really down to earth, like this. These are hometown
Yeah,
heroes, right? The police officers and the nurses. And, at the end of the day, this is why we really believe in what we're doing, because it's, at the end of the day, it's not only providing a great return for our partners and for John and myself as well, because we invest as, right alongside our partners on all of our deals. But what it's also doing is it's changing people's lives at the resident level. And so this is where we get really lit up on providing a
yeah,
wow experience for our residents. And so, yeah, John, like at the end of the day right now, there's a lot more that we're getting, not only from the investment dollars. We're actually, we're changing lives in a positive light as well.
that's right. Well, Mark, I think the bottom line is that, the takeaway from this is if you're frustrated with just the ups and downs of the stock market, take some time and look at your allocation of your investment dollars. And if you're not investing in hard assets, specifically multifamily real estate, run an analysis and allocate some dollars over. You won't be disappointed. Whether it's with us or somebody else, we are very disciplined. It took us 9 months to find this deal in Smyrna. We don't just do a deal to do a deal. We wait for the right deal that we can believe in and invest our own dollars in side by side with our investors. And this is the deal. So reach out to us, book in a time. You can go to fulloutinvesting.com where you can actually see a sample deal deck. That's fulloutinvesting.com. You'll also have a video that you can watch that walks you through our step-by-step process from acquiring and identifying the asset to closing, as well as book a time to talk, which you'll want to do to learn more about this incredible opportunity we have coming.
Right on, guys. Well, we love and believe in you guys. Keep dreaming and investing big.